Hey everyone, welcome to another edition of the Buddy Study Group, and we are joined by a special first-time presenter today. Ramona Neal is joining us as president of the Living Benefit Review, and there is a lot Ramona does for this industry and for Buddy INS, really helping keep us apprised of a lot of industry news, but also just kind of keeping, maintaining, and owning some of the most widespread product knowledge on hybrid life, long-term care, chronic illness, rider products that I personally have seen. And I've been quite dedicated to product information in general in my time here at Buddy INS. So, needless to say, we are speaking with a wealth of knowledge today, and we are going to talk about really the variety of chronic illness riders that are out there on the market, how to really kind of tell them apart, what it really means, what the differences are between them, and really how to apply them to the right cases. And as Ramona put it, if you don't know what you're selling, how will your clients know what you're buying? And I think that's a really good way to tee up, Ramona. And whenever you're ready, you can take it away. We really appreciate you being here with us. Oh, we'll have to unmute you. I think I can ask you to unmute. It may give you a prompt. There you go.
All right. Well, thank you very much for that warm introduction. Can everyone hear me?
Yes, ma'am.
All right. And I only have about 20 slides or so to go through, but I can be kind of long-winded. So I'm thinking it would be safer because I do want to make sure we hit the last slides, that if you could type in your chat questions or just write them down, that we save them to the end, if that's okay.
Of course.
So thanks again for the warm introduction. I love supporting this group. Mark Glickman is absolutely fabulous. And Jason, I've spoken about your talents many, many times. As was stated, today we're going to talk about life insurance rider options. Specifically, what I'd like to do, since I grew up in the life insurance industry, 35 years in life insurance, where the riders kind of took over and have now become table stakes for life insurance. So that's where I grew up. So I did want to talk a little bit about the underlying chassis, because a lot of the people I understand on this call have a long-term care background. And since a lot of the solutions are now combination solutions, I thought we'd just look at some of those basics and then look at some sales trends. A lot of them are from LIMRA, third party, and then talk about some rider trends and then dive into some fundamentals on the different rider solutions, as Jason said. And it was actually a call a few weeks back where a question came up about lawsuits with the riders. And that's why Jason invited me, and thank you. It doesn't apply to all the solutions. There is some risk with some of the riders. And to be clear, all the riders are good riders. It's more a matter of how we represent them to our clients and manage expectations so that if they recognize that you can't accelerate 100% of the death benefit, then they won't be offended when they find out that they can't. It's really fundamentally what it comes down to. And for you to be the insurance professional, even if it is a long-term care focus, when you're now selling solutions on a life insurance chassis, you do have to know them. So as I said, a lot of years in life insurance, 4 years included working with attorneys in advanced sales, and I consider that to be both a blessing and a curse. A curse is usually I'm extremely guarded with what I say, but I had some things come up this week, so I'm less guarded today. That's actually good news for you because now I'm going to be more transparent. The bad news is you now must suffer through this particular slide, which is, the information I'm communicating is not guaranteed. Any opinion statement or information that I share, you have to do your own due diligence. And it is, you do so at your sole risk what you do with that information and anything that you do. Also, you should independently verify information that I share with you. And then obviously, as you know, variations. So I'm going to speak in significant generalities, but there are exceptions and there are state variations. And I'm going to try to stop, whether it's positive or negative, try not to promote specific carriers, products, or solutions, because this is just intended to be educational. All right. So, understanding the underlying chassis. For those of you that have been in this industry for a long time, if you were selling back in the 70s, you remember whole life. What are some main fundamental things I want you to know about whole life? When I'm thinking about whole life, I'm thinking about G. I'm thinking about guarantees, guaranteed premiums, guaranteed cash values, guaranteed death benefit. Yes, it can be a little more costly, but the key feature with whole life is guarantees. It is true that the dividends are not guaranteed, but a lot of the track records from these whole life carriers are phenomenal. So while the dividends are not guaranteed, the product itself is premiums, cash values, death benefit tend to cost a little more. Sometimes they have term riders. The term riders may not be guaranteed as well. But again, when you think of whole life, think of security, think of safety, think of guarantee. And as you know, those juggernauts, those whole life companies, New York Life, Northwestern Mutual, Mass Mutual, Guardian, a lot of them have phenomenal financial ratings and, if not close to a perfect Comdex score, a perfect Comdex score, financial strength. So that's whole life guarantee. The reason I bring it up is that sometimes your clients come to you and they're in their 50s or 60s and they have a rich whole life policy with a lot of cash values and they may be, you may be considering 1035ing it to another product chassis because it has a living benefit rider like a chronic illness or LTC rider. And certainly that may be a good solution, but there are also risks with that. Because you're moving from a guaranteed product to another product category that does not have guarantees, where the insurance company reserves the right to do an in-force action and increase the policy charges. So I just kind of want to make you aware. We may be experts with the long-term chronic illness, the combo solutions, but the underlying chassis matters as well. So whole life, think guarantee. Universal life. In 1985, I was in high school, graduating from high school. Some of you were out in the field selling universal life. You had the personal experience of double-digit interest rates. So these universal life policies were literally crediting double-digit. Now, for universal life, current assumption based on the current assumption of interest rates or accumulation, where the focus is on accumulating the cash value in the policy. And we really haven't had interest rates that high for that long enough to see those products do well. But when you think of universal life and you think back to the 80s when we had double-digit interest rates, notice in the right where I speak to policy management and in-force illustration. Here's what happened back then. Let's say you sold a $300,000 policy and the premium was $3,000 a year. And let's say it was based on an 11% interest rate. Okay. What happened to interest rates after the 80s? They went down. What happens to a lot of producers, life insurance producers, when they sell a life insurance policy? They sell it and they walk away, right? They do not do policy management. They do not meet with the clients regularly. And that's really important because if you started with an 11% interest rate, since the interest rate went down, what was supposed to happen with the premium on the universal life? You had to adjust the premium up. That never happened. And so what happened is 20, 30 years later, you had all these policies lapsing and class action lawsuits because these policies were not monitored. So universal life tends to be less costly than whole life, phenomenal product solutions, but based on current interest rate assumptions. So that's universal life. Those policies need to be monitored. All life insurance policies need to be monitored, but whole life, if the scheduled premium has been paid, would be a lot more forgiving. Also, index universal life. That's the hot product on the market now. And I will say, in the 35 years I've been doing this, permanent products come in favor and they fall out of favor. Right now, IUL is in favor. Whole life is always in favor. But right now, index UL is in favor. And, I do admit there are a lot of complexities with index UL. And if you want to go down the rabbit holes of index UL, in the index strategies and, the par rates and the cap rates and, what happened with AG 49 and the hedging strategies and, point to point versus, averaging. And just if you want to go down the rabbit hole of index UL, you can. And I could go down there with you too. I did over 200 field visits on Index UL. But after we did, you'd ask 10 more questions. Then after those 10 questions were answered, you'd ask 10 more questions. And after those were answered, we'd all circle back to this moment. And this moment is Index UL is a universal life contract. Index UL is a universal life contract. You do not need a securities license to sell Index UL. You are not invested in the index strategy. Instead, you are tracking the underlying index. And that's really important. So fundamentally, with an IUL, you have a 0% guaranteed floor. So a 0% floor, a minimum return. But of course, when you consider policy charges, it's possible to have, negative returns, right? If you have a 0%. So when I talked about doing your own due diligence, what happens sometimes is, like I said, if you're moving a cash-rich policy into an Index UL, that may be entirely suitable, but it all becomes, and it may not be, it all becomes a matter of disclosure and speaking to the fact that what is being illustrated in an index illustration is not going to be comparable to the guarantees that you see with whole life. Notice on the right, I talk about accumulation or protection focus. So when we think of life insurance, typically we think of protection, right? Income replacement, wealth creation, estate protection. Estate planning, that's typically what we think of, right? Protection. But there are a lot of wealthy folks, or even people who have maxed out their 401ks, who are using life insurance as a tax shelter. And so I know Jason worked at a whole life company. He's familiar with this as well. Anyone who's done life insurance, any type of life insurance, wealthy people use life insurance as a tax shelter. They put in as much premium as they can put in, up to the minimum non-MEC. They put in as much premium as they can. And are you ready for this? It grows income tax free. You can transfer money between accounts, income tax free. You can take distributions out, income tax free, as long as it's not a modified endowment contract and the policy stays in force. So sometimes the consumers have a protection focus, sometimes they have an accumulation focus. And I have seen some lawsuits where cash rich whole life is 1035 to, for example, in Index UL that is showing, pretty impressive returns. Those returns don't occur over time. And then the consumer is like, but I didn't understand that. And now I'm losing money because I thought I would earn more. So the point is you just have to just have full disclosure about what type of policy you are selling and understanding what the original intent of the existing policy was and if it's still meeting the needs. Now, again, I certainly support 1035s from any type of product chassis, particularly when you can add a long-term care rider or a chronic illness rider, or if you can do a hybrid. I'm simply talking about full disclosure. I'm just trying to protect you. All right, so we have universal life, those that just pay the current interest rates based on the interest rate environment. We have Index UL, which is also universal life. And although there's a lot of complexities and there might be 50, 60, 70 pages in illustration for Index UL, ultimately, it's a universal life contract. You also have guaranteed universal life. Those products kind of have fell out of favor. You only have maybe less than 10 companies that have a GUL. If you have a GUL policy, think of it as permanent term insurance. Okay, permanent term insurance. GULs typically have no cash values. If you sold a GUL policy, in fact, it almost had vanishing cash values. A few of the companies had a return of premium that was available during certain years, but that was the exception to the rule. GULs are very sensitive to the timing of the premium payment, extremely sensitive because there's no cash value. So for example, let's say I have a $300,000 policy. My scheduled premium is $3,000 a year. And this year I decide instead of making my $3,000 premium, we're going to take a vacation, just a wonderful little small vacation. And then 30 years later, I realize I need to catch up that premium. And so of course I recognize it's not going to be 3,000 anymore, right? I recognize that. But did you think it's possible for it to be 30,000? Or 130,000? It depends. I mean, it absolutely depends. So you have to be very careful with it depends on the size of the policy. You have to be very careful with GULs. In fact, you have to be so careful that even making an early premium payment can negatively impact your death benefit guarantee duration. So you have whole life, you have universal life, and you have variable universal life. Its heyday was in the late 90s. I sat on the sales desk and ran illustrations at 12% and press calculate. Um, then after 9/11, that product pretty much fell out of favor because what life insurance producers found out is that it hurts more to have a negative 30% return than it feels good to have a 30% return. So a lot of the producers that couldn't handle those calls have shied away from variable universal life. In my opinion, the producers that are selling VUL today are professionals. They know variable life. They talk to their clients. They're more like in the advisor category, and they manage expectations well. That last footnote is an important footnote. It's the exception to the rule, but it is possible to have a VUL, a UL, or an IUL that has a death benefit guarantee. It could be built in up to a certain age, life expectancy, like age 85 or whatever life expectancy is, or it can be a rider where you dial in the duration that you want, age 95, age 100, age 120. That would mean if I have a VUL and I have negative 30% every year for the life of the policy, and I have a $500,000 policy, the insurance company is on the hook to pay the $500,000 death benefit. It doesn't matter what the return is every year. I didn't say the cash value was guaranteed. When the death benefit is guaranteed, by definition, the premium is guaranteed. And so we circle back to where I started with whole life. When you think of whole life, premium is guaranteed, cash value is guaranteed, death benefit is guaranteed. It's a very unique product category. It is going to be a little more costly. So when you look at these products, and you're looking at the illustration that the client had as issued, and they're considering a 1035 to a really great solution, you can ask for an in-force illustration to see how that policy is actually performed compared to the as issued illustration, and then help your clients make decisions. To be clear, all these product solutions are great. I personally have a GUL and a VUL. All these product solutions are absolutely phenomenal. It's just about understanding how they work. Just check the time here. All right. I just wanted to get that fundamental because that's what makes me different from a lot of the long-term care experts. The rest of the slides will, a little bit market slides will go pretty quickly, and then we're going to focus on understanding the difference between the riders. This here is from LIMRA. It's their combination product annual review. And, I used to say, what's the number one trend in the life insurance industry in the last 20 years? And it's not index UL, and it wasn't GUL, and it certainly wasn't VUL either. The number one trend are these living benefit solutions. This is not your father's life insurance. So if you look at this chart from LIMRA, look at the bottom. Do you see the key? In blue represents IUL, yellow is UL, green is VUL, orange is whole life, purple is term. Let's look at the first row by policy count. When you look at all the combination solutions, both types of chronic illness riders, the LTC riders and hybrid riders, today, 47% of the time by policy count, they're issued on an IUL chassis, 16% on a whole life chassis. And as you know, sometimes they're even available on term, right? So I just kind of wanted to give you some context of what's happening in the world of life insurance. A lot of IUL is being sold by policy count. Now, if we turn the slide here, what I want to do is, before we go back into the combination products, I want to take a little bit of walk down memory lane for those of you that have been in the traditional market. I was not. You were there. So if I were comparing traditional policy counts to all the combination solutions, the long-term care riders, hybrid life, and chronic illness riders, then I could say by policy count, 93% of the time, solutions sold today are on a combo chassis. They have life insurance involved with them. 7% of the time, it's traditional LTC. So the reason I'm showing this slide is I just want to show you from a trending perspective what's happening. So in 2000, some of the early heyday, 750,000 traditional LTC policies were sold. By 2020, down to less than 50,000. Then in 2021, we had the year of Washington, right? That was a remarkable year. And then in 2023, we had an adjustment. But for 2023, take a look at this number because this is very impressive for traditional LTC. So 34,000 policies sold for traditional LTC because we're not supposed to be impressed by the premium, right? We're supposed to be impressed by the policy count. All right. Now we're looking at combination solutions. And I know, is it fair, Ramona, to count all the chronic illness riders and the LTC and the hybrid life and compare that to traditional? I don't know if it's fair. That's what I'm doing. So all the combination solution products, the chronic illness, the LTC, and the hybrid, let's look at what's happening by policy count. In 2017, 260,000 policies. By 2020, 421,000. Then we had the year of Washington, 560. And then after Washington, there was that adjustment again, just as there were in traditional LTC. And if you remember, how many policies were there for traditional LTC in 2023? 34,000? Look at hybrids. More traditional LTC policies are sold than hybrids. I just think that's interesting. When I say hybrid, I mean linked benefit, I mean asset base, I mean Care Matters, MoneyGuard, Asset Care. That's when I say hybrid, what I'm referring to. Long-term care riders by policy count almost 100,000, but by far the biggest deal is almost 350,000 policies are the chronic illness riders. And that's why I was invited on this call. We're going to get to those chronic illness riders. 300, almost 50,000 chronic illness riders. And of those, most of them do not have an upfront charge. They're free. So most of the time, they don't have an upfront charge. Again, this is from LIMRA Annual Review on Combination Products 2024. If you look at the bottom, again, the key, now we're just looking at combination products and long-term care acceleration. What LIMRA is saying there is long-term care riders. Chronic illness acceleration is chronic illness acceleration of the death benefit. And then LTC extension. When LIMRA says LTC extension or extension of the benefits, what LIMRA is saying are the hybrid linked benefit products like MoneyGuard, Care Matters, Asset Care. That's what LIMRA is saying. And I got to tell you, I'll just pause for 2 seconds. And I don't know. So my mentor is Steve Kane, and he and I chatted earlier in the week. And this is an issue that came up to him, and it's one that he and I discussed. I don't know if it's going to be Steve Kane that rescues us. I don't know if it's going to be Mark Lickman. Jason, I don't know if it'll be you. If Phyllis is on here, if she can help us, if Celeste from CLTC can help us. But we do have a problem with the naming convention as an industry. I mean, this producer from this firm had said, "What's up with this long-term care extension of benefit? What the heck is that? Why can't we just have one name for products like Care Matters and MoneyGuard, right? It's fair." And when someone says hybrid or linked benefit, you could be talking about a chronic illness rider, both types. One that could pay out zero and one that could pay out the full benefit. You could be talking about a long-term care rider. You could be talking about hybrid. So, I don't think we can't blame LIMRA for this because, to be fair, at least when LIMRA says long-term care extension of benefits, when LIMRA says that, they mean products that have the first pool that accelerate the death benefit and then the second pool of pure long-term care. Mark, it looks like, do you have something to say?
Oh no, I'm just rabble-rousing in the chat. Don't worry about me.
Okay, I
Yeah,
saw
I
his
think that's going to
expression.
take a council to fix the naming convention, but individually, we would all just start by saying, "Don't get me started," because we all see it as a huge problem.
Yeah, and I don't know if it'll be ILTCI, but something has to be done. And I mean, I know insurance companies can have a right to name their products what they want to name them, but it's becoming a problem for our industry and it's only going to get worse. All right, so now we're looking at
Oh,
long-term care
Ramona, I have
riders.
a good shortcut.
Yes,
If it has care in the name, it means it's built for long-term care.
good.
Except for MoneyGuard, but all the others have care in the name.
Well,
Just
that's
a
a
just an
very good.
observation, right?
Yep, that's a very good point. That's a very, very good observation. So if you look at the key here, in blue, long-term care riders, yellow, chronic illness, and then extension, those care solutions. Let's look at it by policy count again. Long-term care riders account for 20% of the sales. Chronic illness riders, 73% by policy count. And then the hybrids or extension of benefits, linked benefits, care products, 7%. Now, as you can guess, when you look up and go up one row to total premium, suddenly the extensions make up for more premiums, right? Because those are big, fat, rich policies, right? $100,000 single premium, 200,000. So I just think it's interesting to look at what's going on from a trending perspective. All right, we are, riling up to the chronic illness riders. So we just established that 73% of the time by policy count, when a life insurance combination solution is being sold, by policy count, it's a chronic illness rider. We've established that. Now what? When a chronic illness rider is sold, 88% of the time, it's the kind that has no charge until acceleration. 88% of the time. And even though we'll go into it a little bit more, let's just get straight to the point. When you have a chronic illness rider with an upfront charge, like the same with a long-term care rider or products like Care Matters and MoneyGuard, when you are paying for an upfront charge, then you have a known and predictable benefit that you can accelerate. When you pay for something upfront, you have a known and predictable benefit. When you're not paying for something until the time of acceleration, then it depends on how much is eligible to be accelerated because it depends on your age, your health condition. So if the charge is not even known until you accelerate it, then logically the benefit cannot be known until the time of acceleration, right? So the free riders you are paying for on the back end. And what's important to understand, it's possible that only a fraction will be eligible to be accelerated, such as 30% or 50%. And if you're young enough, like if you get in an accident and you're in a wheelchair and you're in your late 20s, then the amount eligible for acceleration could be zero. Or if you're younger and you get MS, it could be zero. Now, if you look at that second box, the riders with no charge until acceleration illustrate better. Do you remember at the beginning how I talked about the wealthy people use life insurance as a tax shelter? A lot of these policies are sold to focus on the accumulation and distribution. Life insurance, cash value rich, and not just whole life, IUL, a lot of IUL, VUL, whole life. Focus on accumulation and distribution. The actual sales application is referred to as life insurance retirement plan. That's how much of a priority focus it is. So by me saying illustrate better there, what I'm trying to say is if I'm buying my index UL to minimize the death benefit and maximize the cash value to maximize income in retirement because of all that tax preferential treatment, then to be fair, in defense of the insurance companies that have the 88% of these riders, to be fair in their defense, I don't want to pay for a rider charge because that's not my priority focus. My priority focus is to supplement my retirement income. Why on earth would I want an additional rider charge that would be a drag on my policy? So I just want to say, if my priority focus is accumulation and distribution, life insurance retirement plan, then I actually prefer these riders. And that's why, one reason they're popular. Another reason they're popular, I would say, is to be fair, let's say we both have let's say you have a chronic illness rider with upfront charge, and I have a chronic illness rider that's free, no charge till acceleration. And in the world of life insurance, it's very competitive with illustration. Yours has the upfront charge, mine is free, no charge until acceleration. All things being equal, when you press calculate, if a producer doesn't know what's going on, my illustration will look better. And I will win that case because you have the drag of the rider charge. What's kind of heartbreaking is the producer will pick my product with a free rider because it illustrated better. So therefore I get, or my client gets, an inferior chronic illness benefit. So I just wanted to give you a little bit of background on that. From a trending perspective, I think everyone here knows what's going on. Again, will Steve Kane, will Mark Glickman, will you guys be able to save our industry, save us from ourselves? We don't even have the names right. I'm beside myself still. For products like Care Matters and MoneyGuard and Asset Care, we are seeing a trend in the hybrid link benefit market, which I think is interesting. So we've watched how the death benefit went down, right? The death benefit shrunk. We've watched how they've taken the ROP away, and they did so because the market has spoken, and the goal is to focus on the LTC benefit. We are also seeing a trend to focus on non-guaranteed growth elements where the performance of the underlying mutual fund on a VUL chassis or index on an IUL chassis or dividends on a whole life chassis will either extend the LTC benefit duration or increase the monthly benefit. So and I think we're going to see more of that. The hybrid annuities, we have 3 companies in the market. You all know that at least 2 more are poised to enter. And by my count this morning, about at least 7 are doing varying degrees of market assessments. And why? Because apparently there is $84 trillion of money that's getting ready to transfer hands from the boomers. And I think the insurance companies are making a note of that. So those are some of the trends that we've seen, and we're of course going to talk about the rider trends. A couple of key points here that I want to make, just fundamental points. So for the care products that Mark Glickman talked about, hybrid link benefit, I like to describe those in this way. The first pool of money accelerates the death benefit. The second pool of money is pure long-term care, right? What else makes these products unique and different from any other life insurance combination solution is one, they have that second pool of extension of benefits, right? So even when the death benefit is gone, there's still the second pool of pure long-term care. Plus, they offer inflation options. Long-term care riders are qualified as long-term care and can be marketed as such. You can accelerate the entire death benefit. There are about 10 companies I can think of that have a long-term care rider. Chronic illness rider with upfront charge. And remember, you're the one who had a chronic illness rider with upfront charge, and I'm the one who had the free one. Those actually are not as popular. And perhaps, they've got a charge. They cannot be marketed as long-term care. But during the year of Washington, that didn't help, right? So even though chronic illness riders are phenomenal, and we have incredible chronic illness riders in the market, and they're just doing a fine job, it did not help in the state of Washington because it didn't qualify as long-term care. Chronic illness rider where there's no charge until acceleration, the amount eligible to be accelerate depends on your status at the time of claim. It could be a fraction of the death benefit that is eligible to be accelerated. It could be 0. I do like this chart that I swiped from Steve Kane's group, LTCI Partners. On the left, on the x-axis is where your focus is on the long-term care being your priority. And on the Y at the bottom is life insurance as a priority. I just thought this was I tried it with a continuum, but I think what they did was better. So you start off with traditional pure long-term care. Then you have the hybrid link benefits. Then you have long-term care riders. Then you have chronic illness riders. Then you have critical illness and terminal illness, and then you have life insurance. I just thought it was a really great visual to see where all the product solutions are, starting off with pure traditional LTC, and then going to pure life insurance with no living benefit riders. Just thought that was a good view, and generally when I steal stuff, and I have from buddies as well before, I try to get permission after the fact. All right, let's get to, I feel like this group, you have the sales applications of long-term care down. So I want to focus on some key hallmarks for the riders. So with long-term care riders, filed with 7702B of the Internal Revenue Code, it's okay to call them long-term care riders, right? They are not going to compete as well when you press calculate because there's always an upfront charge with them, right? Very robust. And they also have built-in consumer protections, just like traditional LTC. So from an insurance company perspective, it's kind of a hassle to have a qualified long-term care rider because everything has to be filed, not just with life, but with health, and everything has to be approved. It's kind of a big deal. But you do have all those consumer protections that you have with traditional LTC. For the LTC rider market, you can see reimbursement and you can see indemnity. And some of the companies also have a residual death benefit. So if you have a $500,000 policy and you accelerate the entire $500,000 for care expenses, they may have a 10% residual death benefit or 50,000 or 5% residual 25 grand that is still paid as a death benefit to your beneficiary, even after you accelerated the 500 grand. And why would a company do that? Because a life insurance company is a life insurance, and this is what they do. They want to cover those final expenses, those funeral expenses. Now, some companies, whether even if a chronic illness rider, they might do this with a residual death benefit. So you're able to accelerate, you're able to use the entire 500,000, but they may only allow you to use 450,000 for care, and the remaining 50,000 must be paid as a death benefit. Again, we're dealing with life insurance companies. But nonetheless, when you're dealing with a long-term care rider, rest assured you can accelerate the entire death benefit for care expenses. Chronic illness riders, as Jason said, I think this has kind of been my mantra. If you don't know what kind of rider you're selling, how can your clients know, what they're buying? And I mean, it's a fair point. And so naming convention is pretty fundamental because it would be very helpful if we could have a different label for the different categories so that producers would know right off the bat what they're selling. But for you, you'll have to do a little bit of digging. And again, if you have an upfront charge with the chronic illness rider, then you have a known and predictable benefit. It's going to be underwritten. If you have no charge until acceleration, there's a very high chance it's a discount method. It's a calculation that's done on the back end. It depends on your age, your gender, the severity of your condition, and the amount eligible for acceleration depends. It'll probably be a fraction of the death benefit. Because there were misunderstandings and misrepresentations, probably at the agent level, consumers get surprised and upset about that. And then, of course, they file lawsuits, right? And then also, if you're rolling with a term chassis, the way those calculations work will be very surprising. And the amount you would get would be very low. So it's the type of policy, how much premium you've been paid, the cash value, the discounting factor. There are a lot of factors. But what's the high level point? If there is no charge until acceleration, chances are it's a discounted method. Remember when we talked about 88% of the time when a chronic illness rider is sold, chances are it's this type. Now the lean method, these are a little unique. And there's no charge until acceleration. But what's interesting here is there is a known and predictable chronic illness benefit. So let's say I have a $500,000 death benefit. And I have one of these handful of carriers that calculates it with the lean method, $500,000 death benefit. The carrier might say, if you go on claim 2 of 6 ADLs or severe cognitive impairment, then Ramona, then we'll allow you to accelerate 250,000 for chronic illness. So they're giving me that. That's actually known and predictable. What is unknown is the remainder death benefit that will be paid to my beneficiaries. And so because of the compounding loan on the remainder death benefit, the longer that I live and survive, the lower and lower that death benefit goes until zero. Do you see what I'm saying? So the point is, you're paying for the free riders on the back end. So if the rider benefit is important to you, then you're better off getting a rider with an upfront charge. If your focus is life insurance retirement plan, where you are trying to maximize cash value, growth and distribution, you might be entirely fine with these riders. What I think is remarkable is how different these rider solutions are. I literally have spreadsheets and spreadsheets, how different they are. And when you're looking at a life insurance illustration, they can be 50, 60, 70 pages. I'm not exaggerating. A lot of pages. One tip I'll give you is if you know how to do a PDF word search with the binoculars, Do that and search for cognitive or chronic or accelerate, and then you'll go everywhere in that illustration where that term is. But some of these riders, I mean, you would think that some of the new ones would not require the condition to be permanent. That's not true. I watched a new rider come out in the last few years, and they're still requiring the condition to last the rest of the insured's life before you're eligible to accelerate. Some of the, I don't mean to say fine print, some of the footnotes that you see in this illustrations only pay for nursing home care. Or, I mean, can you imagine a 2-year waiting period? Wouldn't you want to know? Or require at least being in the nursing home for 6 months. So, and what else is remarkable, some of these insurance companies, because the demand is so high, again, the sales application might be protection, it might be accumulation. They might have 3 or 4 different types of riders. So even if you know the company you're dealing with, they have different solutions. On the right, some of them have waiver of premium. What's really impressive with some of the riders is as the death benefit grows, so does the benefit that's eligible for acceleration. I think that's very, very impressive. So as the cash value pushes that death benefit up, or with option B death benefit, you have more that's eligible to be accelerated for care expenses. All right, so I think we've, done pretty well with chronic illness riders with an upfront charge. You have a known predictable benefit that's eligible for acceleration. And I think I did a fair job disclosing, appear less competitive on the illustration. Notice that these are prohibited from being described or marketed as long-term care, because they're not. I mean, Mark said they have the name care in it. You cannot refer to these riders as long-term care. It's so hard not to, but they're not qualified as long-term care. And if you take a look at that footnote at the very bottom, although it's unusual, some insurance companies have decided to call their chronic illness rider a chronic illness rider, have it filed with Internal Revenue Code Section 101G. So it's actually called a chronic illness rider, but it still qualifies as long-term care because it's been filed to meet the criteria of the NAIC LTC model regs. I know that's probably, but it is, and those companies will promote their chronic illness rider as qualified long-term care, and rightfully so. But as a general rule, if it's a chronic illness rider, you should not be promoting it as long-term care. No charge until acceleration. We've talked about those. One incredible advantage is I used multiple sclerosis as an example. That might certainly disqualify you from any other solution in the marketplace, unless perhaps the worksite guaranteed issue, right? Maybe, but look here, it is possible for a person to have certain ailments and still be eligible for a solution. And that's because these chronic illness riders do have an extraordinary benefit on the front end. There's no underwriting. They are automatically included up to a certain table rating, and within certain age ranges, which I think is pretty phenomenal. So, and again, we talked about this early on. In the world of life insurance, cash value accumulation and distribution is a big thing. These riders fit that really well. They're allowing the individual to prioritize the maximizing the growth to help supplement their retirement income. And then, oh, by the way, if you need care, then you can accelerate some of the death benefit for care expenses. But quite frankly, if there's enough cash value in there, you can take your distributions yourself, right? The big thing there is in red. It is possible that zero would be eligible for acceleration. And I think that's where some producers get themselves in trouble, is not representing that appropriately. We talked about the 2 methods. The discount method by far is the most prevalent, but I'd have to say, based on the categories I know, there are 4 types of chronic illness rider variations. You have chronic illness riders with upfront charge. You have chronic illness riders that are the discount method. You have chronic illness riders that are the lean method. And then, are you ready for this? You have chronic illness riders that are a combination of what we just described. It's just some other variation. It doesn't fit into any, they're the exception to the rule, but that's how much variation that you'll see. For example, you may be able to accelerate up to 20% a year, but instead of the remainder amount being calculated through the lean method, the remainder amount might be calculated through the discount method. So, I mean, if it's so rare, it's not worth kind of, You know what I mean? If it's the exception to the rule. Critical illness riders, these are really interesting and they're often automatically included as well. They vary significantly. Sometimes the name triggering conditions, you have five and they tend to be the ones you see there: cancer, heart attack, stroke. But some carriers have up to 15 named triggering conditions, which is really interesting. Typically automatically included. Two exceptions are John Hancock and Symetra. And with them, there's an upfront charge. And with them, what is pretty interesting is very unique. It is like a separate second pool because with John Hancock and Symetra, when you accelerate your critical illness rider benefit or cancer benefit with them, it does not reduce your death benefit. You are going to pay for it up front. So there's variations with the critical illness riders. I'm going to leave time for questions here. Again, I'm confident that you're incredibly confident of all the sales applications. The only, this is my opinion here. I would say my opinion is if you have a client that is prioritizing the chronic illness benefit or having, being able to accelerate the death benefit for care expenses, then the chronic illness rider with the discount method would be not the route to go. There are a lot of solutions, but that would be my one warning to you as well. And then knowing that I have all these incredible long-term care experts on the call, you guys know things that we're just now learning in the world of life insurance because you were there. I mean, the nature of long-term care with claims are you have to know the contract language. And in the world of life insurance, before we had all these living benefits, producers and salespeople like me, we used to walk around with the producer and client guide like it was the Bible. But when you're dealing with going on claim, that doesn't matter. The contract matters, right? And you guys learned that lesson a long time ago, but in the life insurance world, producers are just now starting to rely on that. And I'll tell you, since I dived, deep into those contracts, I've seen an indemnity solution where the insurance company reserves the right to require proof of loss on a monthly basis. Not in their producer guide, not in their client guide, but in their contract. I didn't say they had to submit receipts each month. They reserve the right to require indemnity, combo solution, hybrid indemnity, reserve the right to require proof of loss on a monthly basis. Or another indemnity solution, hybrid life solution. In the producer and client guide, speaks to calendar days for the elimination period, and in the contract, they reserve the right to switch it to service days. So if you're selling these solutions, I know you guys do have the specimen contracts, you do read it, but in the life insurance world, we are learning that lesson. I think I've covered some of these. The PDF search functionality, you're looking at a 40, 50, 60, 70 page illustration. Look for the word chronic illness accelerated, cognitive, and then you'll be able to kind of discern what type of rider solution you're selling. If you're concerned about the fact that you've sold some of these that are free up front, and you'd like to make sure you communicate with that client, you can take an inventory and do that. At the beginning, we talked about policy management. So an in-force illustration, if you're meeting with your clients or a client comes to you with an IUL policy or a whole life policy, when the policy was issued, they had an as issued illustration, okay? But now, 20, 30 years later, they've had different performance. Get an in-force illustration and see how the policy is doing compared to what was issued. It could be doing way better. It could be not. If it's not doing as well, not only may they not have income, the policy may lapse. And I'll give you this one example, and Mark, with you being an actuary, you might appreciate this. But I had an actuary give me this assignment, and it was in the Index Universal Life world where we were comparing pricing. And the assignment was to do some stress testing. And instead of the 7% that was being illustrated at the time, he asked me to input 40% randomly for about 12 companies. So randomly, 40%. These policies were issued to maximize cash value and income and distribution. So for example, they may have had like 20 to 40,000 income per year, right? So I went ahead and went through the assignment, and then what happened was one of three things. One thing happened is exactly what you expected. The income was lower, right? I had 0%. A third of the time, the income was lower. Guess what else happened a third of the time with 40%? There was no income. And guess what happened with the last third percent of the time? The policy didn't even make it to maturity, to age 120. It lapsed with 40%. Now, sequence of returns and the timing of those 0% really matters a lot. But that's what I was telling you. You have to understand the underlying chassis. But look at, take a look at what you're selling. Jason started off with it. If you don't know what type of rider you're selling, how can your clients know? I want to shield you from drama in the future. And drama doesn't have to be lawsuit. It just could be, how come you told me I could accelerate the entire 300,000, but the insurance company is telling me it's 100? And if you have other clients or other products in the portfolio with them, or if you make them unhappy, you just potentially lost a client and their heirs. So it's again, all the riders are good. All the rider solutions are good. The problem isn't the riders. The problem is, are we adequately managing expectations on how they work? And then, of course, we talked about the problem at an industry level. Can't we get the name right? So I know I went on a long time, but I wanted to get to this end. Of the questions you've seen, Jason and Mark, is there comments that you guys want to make or questions, please?
There are essentially endless comments. I don't think I've ever had a presenter get this much interaction in the chat. You have inspired almost a separate study group in the chat of people helping each other, asking questions. I think it would be great to just give anyone who would like to raise their hand opportunity to ask Ramona a question in the right around 5 minutes we have left, if you'd like. So if you want to use the raise your hand feature, we can call on you and you can ask
And
Rosanna whatever you like.
I'll,
But
I'll add just kind of my takeaway, and I think this is a good one just overall, is it's intuitive for clients to feel like if there's no charge for the rider, it's a better deal. Where what you're talking about, Ramona, is the opposite. If there's no charge for the long-term care or chronic illness, then you should be skeptical about the contract language. And I think that's the most important part to educate clients on is you might only pay a little bit extra, but you're going to get a lot more benefit from that if that's your goal as long-term care first. But I expect from your LIMRA numbers that because it's free, we're including a lot of products that were bought for the life insurance and not for the long-term care. So don't just assume that they bought the wrong product. Because getting a free living benefit isn't necessarily a bad thing, although there's no free lunch, right? So those are kind of my takeaways. But a lot of people obviously have strong views on how clients are being sold the chronic illness. I think that was one thing we heard a lot of, right? Is a lot of agents are leveraging the chronic illness to sell the product, and their client is going to hold the bag, 30 years from now. And that's where there might be some E&O problems and other things.
yeah, and one comment that Dave made in the chat that bears repeating is in the annuity space, we see this as well. Annuity wholesalers that are promoting long-term care benefits on an annuity product that is not actually long-term care, or not actually 7702B long-term care. We also see, chronic illness riders that are out there on the market that actually do kind of follow all of the contract structure and terms required to meet the definition of long-term care, but are actually called chronic illness. And a lot of that just comes down to say that this is why specialists like yourselves are a requirement for this industry, and commissions are not junk fees. And you should always be, parsing through the contract however you can for any product that you're newly exposed to from anyone out there. And like Rosanna or like Ramona said, that will save you a lot of drama on the back end.
Yeah,
Um,
I guess my warning, if I can add, would be because I like how you guys are summarizing those main key themes that are so important, is when you're selling a life insurance chassis, and then I know it's our business to focus on the chronic illness, or the LTC rider solution, right? It's our focus to focus on those care solutions. But to me, it would be like walking up to a car and focusing on the radio and the leather seats and not being at all involved on the type of engine or the car itself. Is the engine the right engine? And so this when we started off by looking at the policy counts, you know, less than 10% are traditional LTC, right, compared to all the combination solutions. When we have a trend going on in the industry where life insurance now is becoming a prevalent solution, then that means we have a responsibility to learn life insurance more.
Agreed. So we're coming right up on the top of the hour. I think Chris summarizes it perfectly, a fire hose of information, but all extremely, extremely important and valuable. And Ramona, we have you to thank for that, and we really appreciate, like we said in the beginning of the call, what you do for this industry as a whole and keeping us apprised of movements going on in the news and just helping us better understand products that we need to understand if we're going to apply them correctly, promote them correctly, and find the right clients for them. So, again, can't thank you enough for being on here today and for everything that you do. And let's do this again sometime. You inspired a lot of really good conversation, and I can't think that there is a person who was on this call who didn't take away at least one thing, and that's
Wonderful.
a huge objective we try to meet.
Thank you for the opportunity. Bye-bye.
Of course.
Thank you, Ramona. Bye.
Bye.
Thank you, everyone, for being here. We really appreciate the time you spent with us today. Feel free to send us any feedback of what you thought of Ramona's presentation. I'm sure she would love to hear it. I know what I think about it, but for all of you out there, thank you for being here. Thank you for watching the recording. Be well, and we'll talk to you this time next week. Have a good one.